Okay, hey everybody, welcome in. It is Tuesday, June 7th. Thank y'all for the birthday wishes, Stacy, Ed. Appreciate everybody. Yeah, isn't that a great song? I just love. Thank you, Gary. 52 today, y'all. I know what you're thinking. Oh my God, he looks like he's in his 30s. Yeah, I know. It's so funny that all of my classmates I graduated high school with around here. I'm a homebody, right? So I live within 6 miles of where I grew up and went to high school and all that. I don't ever leave, right? I don't ever get out of here. And they've all got grandkids. And my God, some of them have like great grandkids. I'm like, geez, what are young people doing? I'm not old enough to have grandkids. So my oldest kid is 17 and my youngest is 6. I'll be in my 60s by the time she graduates from high school. It's going to be exactly, Matt. 29 never looks so good. So, I mean, you grow up and you never think you'll be like in your 50s, right? It's just all of a sudden one day, boom. It's there. I can remember I cried the day I turned 20. Y'all think I'm lying. I was like, oh my God, it's over. You know, but I'm not crying today. Everything's good. I had my personal workout today. Chicks and even some guys, some dudes are checking me out in the gym, man. And hey, whatever floats your boat, baby. And I'm sitting there pressing around, looking in the mirror, and I didn't take my medicines today. So my trainer was like, dude, you are off the charts. And I'm like, oh yeah, but this is maximum Bobby when I don't take my meds. So anyway, welcome in. Thank y'all for all the great wishes. Some of y'all want to talk about, I ran out of memory on my Thinkorswim. It was having a lot of different trouble because I was trying to some of y'all were focused on notional value, the notional risk of your accounts. And, I'll be like Karen, the super trader. Well, maybe y'all are telling me there's something I need to worry about that I hadn't been worried about. That's what she said, Tom Sosnoff. He's like, Karen, you don't look at your delta? She's like, no, maybe I should look at that. So, maybe I'll plead ignorant and go, maybe I need to start looking at notional value. What is notional value? What is my notional risk in what we're doing? Let me just say this, y'all, and I'm going to say this pretty strong. Okay. If you go through life with the mindset that you can't take risk, then mediocrity is going to be your future. Let me say that again. If you go through your life and you don't take risk, then mediocrity is going to be your future. You and I have to take risk. And unfortunately, there are no riskless trades. There are no riskless endeavors when it comes into the financial markets. When you and I go into the financial markets to tackle it every day, there are those on the other side of your trade who are ready to rip your guts out, right? And so what you decide to do is I'm going to play it safe. So then what you do is you do credit spreads or you buy options that, you think you're going to knock it out of the park. And the problem is the odds are totally against you. Even when you're selling a, dollar wide credit spread, because, well, at least I can lose 100. If I bring in $33, this is good. And so you start going the tasty trade method and you don't want to increase your spreads to $3 wide. So you're going to do $1 wide because you can only afford to lose $100. And all of a sudden you're going to see your account be decimated. And the reason is because you're not taking sufficient risk in order to make it. If you look at anybody in the world who has been successful, they are risk takers. Elon Musk is a risk taker. Right? Steve Jobs was a risk taker. You have to be a risk taker. Now, so all the money that you see me trading, what we've got, I trade my 2 accounts. I trade another guy's account. But on my 2 accounts that y'all see, I got about $130,000 in it. If the world goes to hell in a handbasket. And, you know, we have, like someone mentioned, what if we have a 75% drop in the S&P? Well, you know, I'm going to crap my pants. And what's going to happen is if we had a 75% drop in the S&P, which I don't foresee happening, but if we had it, then there is a great probability that I would blow these accounts out and they would go down to zero. Now, is it possible that I could owe the broker money? Yeah, it's possible that I could owe them money at the end of the day if it, you know, went below zero and, you know, they didn't shut things out. There's a decent chance, I believe above decent chance, that they would start to close my positions and
Hey, Bobby, sorry to interrupt you.
Yes.
But I think somebody's waiting to get into the room.
Thank you so much, man. I appreciate that. And I don't know why I got to fix this thing so y'all can just come in. I hate y'all not being able to get in. So thanks for telling me that. If y'all see someone waiting, let me know. But the problem is, you know, they would close my account down. Or if they didn't close my account down and, you know, I owed them $100,000 or so, now that'd be a little problem. But if my accounts, my $130,000 go to zero, it's been fun. It's been fun. Now, problem is, well, I wouldn't say the problem. The good thing is that going to change my life? No. Is it going to make my kids go without food? No, it's not. So what I'm trying to tell you is this: you've got to be a risk taker. You've got to assume some risk when you're doing this. You just can't, you know, eliminate all risk. People are asking me now, Bobby, why are you not having the VIX hedge on right now? Because you can't do the VIX hedge right now. If, you know, you're going to lose money if you're putting on a VIX hedge with VIX in the 20%, you know, VIX between 20 and 30. You can't put on VIX at 30. You can't, you know, buy VIX calls at 30 and go, whoa, well, did we get in there? Well, we're ready to go now. You just can't do it. And, you know, is it the best time to put on black swan hedges when we've already had a 13% market correction in 2022? No. Now, when I'm most concerned about black swan events, now black swan event can happen anytime. We could have Russia to nuke France tomorrow and the world is at war, right? We're at World War III. So, you know, anything could happen, but I assume the risk, right? Here I am, I'm assuming the risk. I cannot eliminate all risk, and you can't either. And if you try to do that, you're going to lose money. Yeah, plain and simple. So if you want to eliminate all risk, what you should do is dollar cost average into the S&P 500 by buying SPY or one of the Vanguard S&P 500 funds, and you should dollar cost average every week or every month and do it over a lifetime. That's how you do it. That's what I started doing when I was 18 years old. That's what I did. I put it all in the C fund in my little government thing, and they matched me up to 5%. Right? The federal government did. They matched me, and I put in the SP 500. And I didn't care if we went to war in Afghanistan. I didn't care if Y2K was going to kill us all. And I didn't care if, you know, we got all killed by the bird flu. I didn't care if we got all killed by the coronavirus. I didn't care about all that stuff. I just put it in the SP 500, and I did it week in and week out and week in over a lifetime. That is how you accumulate wealth in this country. It truly is. So that's how you accumulate wealth. Now, for some of you who have accumulated wealth, and you are like me, you're a nerd, an addict, and you like trading, this is awesome. This is a great thing. It can be very fruitful, but you just can't eliminate all risk. You just can't. So I know that tastytrade has some, you know, parameters for notional risk, how much notional you should take in your account. And keep in mind that we do best when we don't trade individual stocks. I tried to impress y'all. We've done that a number of times. I try to impress y'all, show y'all all the stuff, but it all the time goes back to me just trading what I do best, and that's futures. And futures primarily in the SP 500. So, You can't eliminate all risk. You've got to assume the risk. How big is your trading account? If your trading account is $2,000 and you're worried about, blowing it up, you're probably going to blow it up. All right. If you're worried about all the risks that are out there, you're probably going to blow your little account. It's just going to happen. And trust me, I've been there and done that. I'm the worst among all of them. I've blown out several. So, then I go, crap, I got to start over. And so, you transfer money from somewhere else that you got money and you start putting it in. It happens. So here's the good thing. Well, it's not necessarily a good thing. I don't care how old some of you are. Some of you may be 18, some of you may be in your 60s, some of you may be 70s or 80s. Here's the cool thing. In 100 years, you and I are all going to be dead. Okay? So get over it. Get over yourself. You cannot live in a riskless society. So you have to take risks. Now, the cool thing about us and our trading accounts is we treat this like a business. It is a business. It's a business where we have inventory, but we don't have to house our inventory because our inventory is housed by our brokers, right? So we don't have a physical inventory. We don't have to rent warehouse space. We don't have to rent offices. All we need is an internet connection and a phone and maybe a laptop computer. That's all we need to trade. So you don't have a lot of the risk that a lot of people in business have. So a lot of people in business have, hey, I've got to advertise. You and I don't have to advertise, not a bit. We don't have to advertise, oh, I got to sell an option today. We trade in liquid markets and someone is readily there on the other side of our trade to take the trade, right? You don't have to advertise. You don't have to pay gas. You don't have office staff. You don't have administrative staff. You don't have marketing budgets. We ain't got any of that. So I think we need to wake up and say, yeah, this is kind of cool. Ed, yes, absolutely. You can make a comment.
Hey, Bobby, thank you. First, happy birthday.
Thank you, Ed. I appreciate that.
It was me in the chat room that's been, in fact, I even changed my name from Ed K to Notional Ed because someone was poking fun at me about talking about notional so much. So,
and I'm not getting on you, Ed, for talking about
No.
I'm not getting on it at all.
I think everything you're saying is spot on. I think if people over hedge, then they're eating up all their potential profits and leaving themselves open to a negative expectancy. So I understand what you're saying. What I was really getting at is twofold. One, I don't think people understand broadly the difference between MES, SPY, ES, and SPX. They don't understand the different notional value of those things. And I know that as you're doing your trades and you're showing the Greeks and the buying power, I have learned so much from you watching you do that. And I continue to watch because every day there's a little tidbit at least that I can add to my knowledge set. So thank you so much for that. But what I'm finding out there and rather broadly is people are like fascinated because they can get more doing XSP than they can MES in premium and they don't understand why. So among other things, and I think maybe people are potentially overloading themselves with more notional value than they understand and they don't. So that's part one. And that might be a homework thing. And I've kind of tried to explain it to people. So that's number one. And number two is, and I went into the chat yesterday, if someone sells a 111 or a 112 and it has an overall 6 or 7 delta, and the market goes down, that delta goes up and the buying power requirement goes up and blah, blah, blah. And if they have too many positions on, that's when a margin call can occur. So hopefully more people understand that part, but I think they're starting out on a bad foundation of not understanding the notional value they're taking on by potentially taking on too many positions over too fast of a period or before they know exactly what they're doing. So that's where I was coming from with that.
And you bring up great points. So let's look at it, okay? So if you and I, that's great, Ed, I appreciate that. So let's talk about it. Let's talk about the micro first. Now, here's one of the big questions that I get. And Ed, correct me if I mix up anything on this, but one of the biggest questions that I get, oh my gosh, Bobby, look at the commissions that you're paying. So someone wants to see my commissions and I showed them, I think, the 2 accounts in Thinkorswim, I'm at, what was it, Ed? I posted it the other day.
A little over $2,000.
A little
over
2,000.
2,000.
Yeah, a little
Yeah.
over 2,000. And so people say, hey, Bob, why not trade the E-minis, do less trades, do less commissions, right? And so my response was, I like being able, because number one, I'm a trader nerd. That's the name of our group. I'm a trader addict. I like doing me a daily trade rather than doing a trade maybe every 2 weeks. So could I trade a bigger product? Yes. So let's make sure that we understand how big is the E-minis compared to the micros. Does anybody know?
1/10.
Right. So the E-minis are 10 times the size of the micros. All right. So if I'm doing a trade a day, then that means that I can go Monday through Friday, that'll be 5. I could go next week and do another 5 before I could do one E-mini trade. Everybody agree with that, right? So yeah. Now, what is the relationship of SPX to the E-minis? Anybody know
Twice.
that?
Twice.
Exactly, twice. So SPX is 2 times the size of the E-minis,
And
right?
20 times the size of MES.
And 20 times the size of MES. All right, so let me give you another one. Y'all doing great on this. What is the relationship of SPX to SPY?
10 times.
SPX is 10 times greater than SPY.
Now, Bobby, you realize I'm the one answering all these. This is still Ed.
Yeah, but that's still good, right? That and I think you're right. We need to make sure that we cover these things, because some people are saying, I'm just going to do the E-minis. Make sure, as you say, because the notional value, as we're talking about, notional risk of the E-minis is going to be how many times the micros?
10.
10 times. So we got to make sure that it is important that we understand the relationship of all these products. And I think you're probably right. I don't talk about that enough, because I don't want anybody going too big and trading things that you shouldn't trade. Because y'all are like, man, you're telling me this trade has a 98% probability of profit. And even in a bear market, not a single 112 would have lost money. Yeah. But don't get too big, right? Don't get too big for our britches. So let's look at the notional risk of a micro. So let's just go 52 days. And if I were to sell an at the money, right? So we're at 41.15. If I sell the 41.10 put, what is my risk? What is my notional risk? Ed, what's my notional risk of the micro?
It is, I'm looking at the screen, I'm sorry. It's 50 times whatever the strike is.
Okay, so everybody check it out. My max risk on this position, right? If I were to sell an at the money, is $19,000, right? Almost $20,000. So everybody's got that, right? So let's go to the E-minis. So let's do the same thing. Let's go to the E-minis. If I were to go to the E-minis and I were to sell an at the money, let's go where we would normally go, 52 days. We'll sell an at the money here. What is my max loss, or what we would call a notional risk for the thing, is almost $200,000. That is important to know, right? 19,000, 198,000. Now, do you everybody see why I would rather put on daily trades? I mean, it's the same notional value, right? It's the same max risk that I would have in this if I were doing it every 2 weeks. Now, this one particular trade could greatly work against me more than perhaps some of those little micro trades that I had put on when the market was going down and up. One of the things you guys may realize is that one of the things when we started talking about all of this, you remember we did a little thing that says market, what was it? Direction is irrelevant. What was the thing, Rick? Rick, you still here? What was that thing we had in the thing that said, it was a great thing. It was like, direction is irrelevant if you're putting on a trade every day, right? Because you could take that strangle and wherever the market was going. Let's see if I can draw it.
Well, you're effectively dollar cost averaging your positions.
Yeah, you're effectively dollar cost averaging your positions. So it kind of looked like this. Where's my little pen, Bobby? Here it is. If I can do a little drawing on a new whiteboard. I hadn't whiteboarded it for a while. Yeah. All right, so it kind of looks like this, right? So let's say here's what the market does. Market does this, 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 this on a daily basis, right? It's doing all this, and you're like, crud, man. So what we do is let's say that I was just doing one trade a week. Well, where am I going to put it? Well, you sit here and go, well, yeah, I had a good drop, so it's a great time to sell puts here, right? I can only do one trade a week. And then you go, crap, this would have been a better time to sell my put, right? So what I'm saying is, rather than guessing when is the best day over a 2-week period to sell my put, we'll do it on Fridays. Well, if you do it on Friday, you did it let's say this was Friday, you did it at a horrible time because you sold your put when the market is up. Here's why I like the daily trade. So here I'm selling a put. 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 I'm selling a put on all of these days, right? So that I am, as Ed said, effectively dollar cost averaging into the trade. Now, do you see how much more powerful that is than just doing one mega trade? And you go, when do I do it? I'm going to do it here. Well, then all of a sudden that one trade is really working against you, right? If you sold the put here and then the market does what? It goes down to here. It goes past where your strike was in. So what I like doing is putting the trade on more frequently. Now, some people will say, Bobby, you paying more commission. I got it. But I don't have to have warehouse. I don't have to have shipping. I don't have to have marketing. I don't have to. So yeah, I'm paying a little bit for commission, but I'm not that concerned about it. Okay. So yeah, notional, and Ed's coming from a point, he just doesn't want anybody getting too big so that we're blowing out accounts. Here's why I don't trade the E-mini in either one of these accounts. It's just too big. I can't make these daily little decisions of where to sell the put because I don't know. I don't know where the best time is. But here, you can have trades working for you here and against you here, and they all kind of over time just kind of work out. So I really don't care what the direction of the market is. Anything else, Ed, that you think we need to cover on, maybe it's something that I need to look at more often. I'll be the first to say I'll be curious to see the trader today.
Bobby, I think you're fine with your account size. I think there are a lot of people. I've literally talked to people with $2,000 accounts and multi-million-dollar accounts, and they all had more risk on than they understood.
Yeah.
Rarely have I found anyone who understands, and I call it notional risk because they don't understand if they've got X number of micros on even, they think, oh, it's all they see is the upside. They don't see the potential downside cut. And you said, I don't know, a couple months ago, span margin is your best date until it turns sour or something like that.
Oh, she will turn on.
And so, in this recent plunge from March into May, I was staying very small, and I don't do daily trades, but I do more frequent trades in SPY. In one account, I do less frequent trades in my IRA, and I use ES. So I'm effectively balancing all that out. And I saw what my margin did in that particularly May swoon on all of those, but especially I had 2 ES trades on at the time. My plan was I have an $80,000 IRA. My plan was to get up to 4 ES trades in that one a week. And I did one, and then I was kind of chicken, so I waited and did a second one a week later. And again, my other accounts got a pretty good amount of SPY 111 and 112s in it. And when that market tanked, my buying power went from like 22 to 55%. without changing anything. And I'm like, oh my God, I don't think I want to get up to 4 positions of ES with my $80,000 account. It's an IRA. I don't have an effective way to put more money in, blah, blah, blah. So I kind of backed off and I've stayed at 2. Now, under normal conditions, yeah, I probably could crank it up to 4. But that was a real life experiment where I learned a lot about margin expansion, span margin expansion. In my other account, I had portfolio margin, which I don't know if any of us actually understands the one-to-one comparison. I don't, and I don't need to, but I know it's similar. It magnifies your margin ability. So I've cut back for the time being to 2. And when we get in a better market environment, I'll probably tick it up to 3. Maybe I'll even tick it up to 4, but I'm going to go very slow. The other point that I preach a lot about, and you go into it, but until you feel it in your account, the maturity of the put debit spreads over time, like they're near worthless when you first put it on. But if you have a 60-day trade, or I'll do 30 to 60 in these things. If you have a put debit spread that's more than half into its life expectancy and really 2/3, it is very resilient. So in that period where the market was really tanking in May, I had some mature put debit spreads. I had 150 wide and I had 100 wide that I had put on and just took in less premium because the market was looking terrifying to me. So I'm like, let me put some extra protection on. I didn't exactly know how those things function then because I'm relatively new. And I mean, by relatively new, under a year. I started studying all this in another room where a lot of your participants have come from, which I don't know if I should even mention it, but it's one where they sold naked puts and put a 200% stop on and did daily entry. I'm not going to mention the name.
You mentioned that's David's room, right? David's son?
Yes, that's exactly it. And David puts out a lot of great information. I mean, I learned so much by going through his podcasts and the information he has on his website, et cetera. And fortunately, and I have decades of market experience, but not trading this type of way. So I went very slow. I have sold some real estate, and I've preached all this. I'm not saying anything that most of you people haven't seen me type over and over ad nauseum. I'm sure people see my posts and like ignore them a lot of the time. I'm so repetitive. But I started small. I liquidated some of my real estate holdings in recent months, and I'm growing my account. So I'm going very small. I do not want to risk the profit that I made in those real estate transactions by going too fast in the market. So I went very small. And fortunately for me, and unfortunately for others, I watched people get scorched, and I mean scorched, in January, and then again in February, and then again in March, as the market took these violent downturns and they were loaded up with all these naked puts, either with or without hedges on, because he doesn't exactly profess that the need for hedges are guaranteed. And I don't necessarily know how much they're needed if you stay small and have the ability to roll out positions that are challenged. So watching all that made me somewhat terrified of going too fast. So it's been a great learning experience. And I don't even hang out in his room anymore. He shut it down, made people retest, and he lost control of his room. I suspect that he's probably encountering some pain in his hedge fund and maybe losing money. Okay, I won't go too far into that. But I've switched to your room 100%. Your methodology is so useful and so handy and so real that it's very educational, but people are always almost universally in a hurry to make money, and they don't understand the downside. And even though I was going slow, I didn't understand the downside. I was just accidentally fortunate. I only had 2 ES trades on instead of 4 or even more in my IRA, because I would have been scorched. So some of it was luck. Some of it was just is my nature, because, another one of my sayings is missed money is a lot better than lost money. So, and by that, I mean, I'd rather miss out on making money than lose money. Now, I want to reflect back to what you said at the beginning. We have to take risk. If we're not going to take risk, then dollar cost average into SPY, do it over decades, let compound interest work for you and become wealthy. There's zero wrong with that. Anyway, I'm probably getting off subject, but I'll stop and let you continue.
Well, and let me say this about our room, and regardless of, I noticed a lot of people have come from other rooms and stuff. Well, let me just say a little bit about our Discord room. What is unusual about our Discord room? Well, and every now and then, you know, there'll be heads butting every now and then, and that is because typically we are alpha type A personalities that are traders. As most of y'all know, if you will simply Google Sweet Bobby, you will realize that I am hated in various communities. And you will also see that I have butted heads with a lot of people, and we fuss and argue. And I got tired of that. And I realized very shortly that most traders, and we've said this before, most traders are a-holes. They just are. They're just evil. They're hateful. They sit in their own little rooms. They all want to pretend that they know everything. They criticize anybody that asks a question. They criticize anybody that brings up a different point of view, and they're just hateful. Oh my God, they're just hateful. And what I would say about our room is that it's been a joy, because especially in our 111 channel of our Discord, I mean, that is the most active. I wake up at 3 in the morning and it'll say there's 30 messages in there. And at 3 in the morning, I'm reading all the messages in the 111 channel, and everybody's learning and they're pitching in and they're trying to help people, which is just extraordinary. And Ed, don't say that you're, you know, participating too much in there, because you've been a great help to a lot of people, and a lot of others are in there participating and helping. And one of the great things about the 111 trade and the 112s that we're doing is they're so versatile. And so take away, y'all don't have to manage them like I do. Y'all don't have to, you know, if your account's $2,000, you know, you can't put on one every day like I'm putting on. And maybe I need to stress that a little more, you know, because I don't want you blowing out y'all's accounts. I want everybody to be really, really safe, but I do want you to be a risk taker. Which will serve you well over the course of your life. Let's just go through a couple of things, right? Who was the guy who went into business, in the goat business, because I was going to sell goats to Cubans because Cubans love goat meat? Okay, that was me, right? And then we figured out, hey, you can't ship goats to Cuba. You can't even get them to Miami from here. So that was a stupid business that I went. Who bought a real estate magazine? Went into a print magazine at the time that print was dead. I mean, I had a full-fledged, you know, nice glossy magazine with real estate pictures in it of homes. And I mean, it was the most beautiful magazine. And I went in at a time when everything was going digital. I'm an idiot when it comes to business. I'm the worst trader on the planet. But I'm a lot better than I used to be, because I used to be hard. So, and I don't want any of you to ever think that I know it all. Oh my gosh, how many times did I tell you I'm the worst on the planet? Don't follow me. I have no idea what I'm doing, but I'm not quite as bad as I used to be. And for those of you that are in this room and that pitch out to help other people, it's just phenomenal. And I appreciate y'all not being the a-holes that people are in other groups and other, you know, not to throw off on anyone else, but if you
And
go,
Bobby, if I could just chime in on that, just keep doing what you're doing, because I've hung out in a lot of chat rooms over the years. There is a ton of love, and I hate to sound like a hokey person, but there's a ton of love in your chat room and in your Discord room. And I think there's tremendous synergy going on there. So I just want to give you that positive reinforcement. And you know, you mentioned your accent at one time, like, you know, and I commented back, the only accent I hear is someone who's trying to help, you know, I forgot exactly how I worded it, but it was something like, the only accent I hear, brother, is from someone who's trying to help everyone, and that's it. And a couple of people chimed in, and that's the truth. And you're right. Most traders are hateful, mean, and very, very, very proprietary. Like their chart or their little trading method is gold. And if I release it into the general public, it's going to get watered down and worthless. Your room is the opposite of that. Your room is filled with people who want to contribute, who I think generally care about others. And for someone like myself who does sit in a room by themselves most of the day when I'm not dealing with my other real estate and other responsibilities, but these are my full-time jobs. I manage my own owned real estate and my own investment account. And let me tell you something, your room, I cannot tell you how much positivity I get from your room. And if you look at the frequency of posts I do from usually early in the morning until late at night, I even woke up at 3 something this morning, couldn't sleep, came in and did a little post or two. Like your room fills part of my personal life with happiness and joy and learning that I was not getting elsewhere. And I mean, I have a wife and family, so I'm not just a person sitting here in isolation, but I am sitting here in isolation. And, you know, I cannot give you enough kudos and encouragement to keep doing what you're doing, because it's like a miracle to me. And I think a lot of other people think the same.
I appreciate those comments. And again, though, it's y'all that, you know, make up the room. And, you know, when we started this in the very beginning, you know, with Ken and Matt and Rick, and just at the very beginning, everybody was just so eager to pitch in and to make sure. And it's so funny, y'all, if y'all go back and look at all the crazy stuff that we've done, you know, Matt got us trading DraftKings, and thank God we got out of that. We pick at Matt a lot, but you know, some of the different stuff that we've been through. We went through the AIM, which is great. We went through Bain, which was great. We went through a lot of things, and we, you know, but at the end of the day, we kind of got back to what we are best at. And I think it's just overall portfolio management. So yeah, everybody know your risk. I appreciate y'all talking about notional risk. I appreciate that y'all wanted to talk about it more. It probably is something that we need to mention more. We just need to know the size of the products that we are trading, right? What does anybody know what you know, Tasty Trade has a metric for notional value? And do you know what that is? They go, is it like 3 times of your account size, or is it 6 times? I can't remember.
I don't, Bobby. And I was before all this, I was a big Tasty trader, like from 2016, 2017 on, where I really started cutting my teeth on all this.
And Ed, you started losing money like the rest of us did.
Yeah, exactly. And I mean, it was beautiful. I just put like 30 grand into an account. And
Yeah.
I turned the 30 into 50. And then I added another 75, and I proceeded to lose 20 grand. So that, you know, the Tasty Trade way is great. And as I've discussed in the room a few times, you start out back, and then you start chasing your own tail back and forth. And first thing you know, and their trade small, trade often thing, I get it. You know, we're kind of trading small and trading often here. So I get that. But when you keep building, and especially in individual stocks and even ETFs, when you keep trading back and forth, balancing, a lot of the time you end up with a bloated position. And if that thing keeps ripping against you, you really have no choice but to take it and take that loss and that pain. And I started out with, again, you can all tell that I'm very conservative. Very few individual stocks at all. I don't care if they have a multiple of volatility and much bigger premium, et cetera, et cetera. Doesn't matter. So almost immediately I went from individual stocks to ETFs and proceeded to get stuck in some ETF trades. Like, I hate to say, but Brazil, you know, like if you start out with something with low volatility and the volatility increases and you keep rolling and rolling and rolling and that volatility never comes out, you effectively, in my opinion, don't get out of that trade. So one thing that I learned in David Sun's studies is that of skew, which you went over the other day, and much to your credit is definitely needed to be understood. SPY has put skew. And that put skew is what makes all of this viable in my mind. So when you started doing the call stuff, I understand the call stuff to kind of somewhat balance out the deltas. And I do think there's a place for it even now, even though you say there's not, but on a very, very limited basis, like 1 to 5 or 1 to 10. Like, don't do a lot of that call stuff because, as you pointed out the other day, and we've been talking about in the room a little this morning, the skew does not exist on the call side. So that means you're not, if you go X points, you explained all this, Bobby, but if you go X points away from spot up and down, you're going to get about twice the premium, give or take, on the put side. That's extra skew. That is extra premium you're collecting for effectively taking a somewhat similar risk, somewhat similar. So I think the skew thing is what makes SPY and SPX and all those derivative products of the S&P 500 so important to focus on. And I have washed my hands 100% of even ETF trades. Now, is that permanent? No. Like I follow the metals. And at some point, once I hone my skills and get this down much better than I think I have it down now, I'm probably going to delve back into the metals because the metals have upside skew generally. And I think there's some opportunity there, but why? Like, because SPY and it's, the S&P 500 derivative products, they're always going to have that negative skew. There's always going to be a fear factor of the general public, the hedgies, et cetera, for downside moves, violent downside moves in the SPY and all those products. So, I'm not sure I'm ever going back to any other ETF but SPY. But if I do, it's only going to be in skewed products. And I'll trade in the direction of the skew.
Yeah, well said. And the more markets that I focus on, the less successful I am. It seems like to me, being able to focus on something like the S&P 500 just seems so easy. Even when we were doing TQQQ, and then I had to look at NASDAQ, right? Was I don't know. What I wanted to show you though is I had a spreadsheet. Y'all know me and spreadsheets. How many times I updated? I wish I could find it. I'll find
Bobby,
it.
I'm sorry, I'm going to interrupt you. In that regard, SPY is a diversified product. It's filled with conglomerates, industrials, metals, utilities, blah, 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 technology, blah, 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 blah. It's diversified in and of itself. And as we leg into these 111, 112 positions, as you pointed out on your graph earlier, and we discussed, in my opinion, you are dollar cost averaging there. So the dollar cost averaging into what I consider a diversified product is in effect double diversification. You are getting the diversification.
Exactly. And, it's like I got all upset. Beth and I were going to the gym today, and I'm listening to the newscast. And, at the top of the hour, they give the news, and you're hearing, whatever. And then they quote the Dow, and they quoted the NASDAQ. And I said, where's the S&P 500? I think, who cares about the Dow? 30 stocks. And I'm sitting there going, someone ought to call all these radio stations and these TV stations that quote the Dow every day and said, nobody cares about the stinking Dow. Stop giving me about the Dow. It's the S&P 500 that is the gauge for the S&P 500. Let's see if I can see this. So I want to show y'all something. I wanted to show y'all something. Look at these crazy spreadsheets, Super Trader spreadsheet. Let's see. I had one from 2016. I wanted to show y'all something, and I wish I could find it. Maybe I'll find it for tomorrow. But I just want to show you the 2016 spreadsheet that I had. And that one was in the 2016 era. all I was doing was selling naked puts into E-minis. We didn't have the micros, but I was selling naked puts in the E-minis, and I was selling naked calls in the E-minis. So it was kind of cool, right? We didn't have the micros, we didn't have anything else. So I was trading E-minis, doing the futures then. And I just wanted to show you what I was doing back then is doing, see if I could write it down for you. I was keeping my deltas at -1 to -2 Vega. So my deltas were -1, my Vegas were -2 to Vega, right? And I did that the entire year. And I wish I could show you all those results. They were super results. And that's one of the things that I was trying to keep risk in check. So let's go through one more thing. And one of my things that I said, I don't look at notional value, right? I don't look at notional. Why? Because there's a couple of metrics that I use to look at my risk. And number one, everybody knows what my risk metrics are, but then we'll look at my notional real quick. So the things that I look at is we want to make sure that my theta, see, everybody that sells options go, man, I want as much theta as I can possibly get, right? Theta is good. No, theta is good, but too much theta is bad. So we want to make sure that we have enough theta, which is 0.10% of our total net lick, to no more than 1% of your net lick. If your theta is greater than 1% of your net lick, you are taking too much risk. You just are. So look at it. Now, I would even say that maybe theta greater than 0.5% of your portfolio balance is too much, right? So generally, we want to be between 0.1 to 0.5% of your net lick. So that's one metric I look at. Second metric that I look at, and y'all know what the stuff is that I look at. Second metric that I look at is my buying power. And someone posted this in our thing too, right? Buying power. So depending on volatility, on what the VIX is, you know, we never want to use more than 50% of our buying power in our account. Now, I asked Tom Sosnoff one time, I said, Tom, that's your requirements for a regular account. But what about if you're trading under span margin? Does it still apply? His answer was yes. But maybe that's even too much, you know, when you're using span margin. Y'all, span margin, like you said, she's pretty. Boy, is she gorgeous, because, you know, you can do things that you can't do with SPY. Boy, she's quite the lady. But let me tell you something, when that volatility explodes and you got margin calls because, you know, it blows up, and a lot of y'all haven't seen that. It can be downright ugly. So control your buying power. Now, if you've got a $2,000 account, you're probably having to use 50% of your account, you know, in buying power. So that's another metric of risk to make sure that I'm not taking too much risk. And then there's also directional risk. And directional risk is this: I don't want my deltas, plus or negative, to be greater than 0.0015 times my account balance, right? And we did it before. Remember, we took our $100,000 account. Make sure I got my little thing right. Times 0.0015, 150. So a $100,000 account, I don't want my deltas to be over plus 150 or less than negative 150. Now, finally, we've been going for about an hour, so let's get this over. So here I've got my $100,000 account. What is it? 99,000, 98,000, whatever it is. And what is my notional value? So I basically said, what happens if the account goes to zero? Right? What happens if SPY goes to zero, or the macros go to zero? So here it tells you if we're down 12%, you know, hey, I'm down $6,000. It says if SPY goes down 100%, what is my ultimate notional risk of the product in this particular $100,000 account? $846,238.27. That is how much I would lose if the micros, if the E-minis go to zero. Is that too much? Maybe, maybe not. For some reason, I was thinking that Tasty Trade says, maybe 6 to 8 times your count size and notional value. If it is 8 times, then I'm at the max, or I'm a little over that. If it's 6 times, then that should be, 600,000. So maybe I'm taking, a little too much risk. So I think Ed brings up a great thing. It is important. Know your risk. Know your risk. And let's do a Google search. Let's do Tasty Trade notional value. I know they've got a metric on it somewhere. We'll find it together. Tasty Trade notional value. Tasty Trade notional value. Let's see what we got.
Bobby, while you're looking that up, I do think the notional value, it needs to be understood because people need to understand the relationship between MES, SPY, and XSP, ES, and SPX. So that in a way is notional. And then they also need to, because I don't expect the market to go to zero. Someone posted something on the page, I don't know, last week, and I listened to their hour-long video, and the guy postulated, like, what happens if we get in all these option positions and the market closes for X amount of time and then opens up down 50 or 60% 2 weeks from now? Blah, 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 blah. And I mean, like, first of all, everyone's gut reaction is we got a lot of other problems besides our account blowing up. But and that's not really what I'm worried about, although an asteroid could strike the Atlantic Ocean off the coast and wipe out the East Coast, and we would have a giant, like, there are things that could cause the market to plunge and stay down, I think. So, but that is part of the risk taking that you talked about at the beginning. I think if you understand these other things, I hate to say they're esoteric, but they're things that I am learning over the months and getting a better feel for, your buying power, your ratios, et cetera. They've been tremendous help. But I even find them somewhat conceptually hard to understand. And that's why I like watching your daily video, because a little more sinks in day after day after day. But I can tell you this, when I have on 2 ES contracts, and I watch the market go, and I know I'm trading the equivalent of 1,000 shares of SPY, and I'm watching that thing whip around. It helps me personally to know that I'm trading the equivalent more or less, because it's delta adjusted, more or less, I'm trading 1,000 shares of SPY. And I'm doing it with $80,000. So that $80,000 is controlling $412,000 worth of SPY. I understand why why it's whipping around all over the place. And you add volatility, the VIX changes into that, blah, blah, blah. So just conceptually, I think if everyone understood the notional value of what they're trading, that would be a better foundation, unless they've got all this other stuff really well down already. That's my only point of the notional importance. Once you have all your stuff down that you preach every day, I don't think you really need to track your notional. But if you don't have it down, and I mean really down, the notional is kind of an easier concept to understand what's going on with your account.
Yeah, yeah. I think that's great. And you brought up a great point too on delta. And let's make sure everybody realizes this. Everybody, what he just said is when we beta weight to SPY, if you look at your delta, and your delta is positive 101, that means that your account is the equivalent of owning 100 shares of SPY that is currently trading at, what is SPY? It's at 412, right? So you effectively have 100 shares of something that is trading at $412 per share. Now, check it out. My deltas are negative 100. But this means that I am short 100 shares. It's kind of neat that it adds up exactly to 100 right now. I am short 100 shares of SPY in this account. Now, if you're going to be positive or negative delta, why would you rather be negative delta? Does anybody know? And then the trading of options, let's have this discussion. Why is it better to have a little bit of negative delta? Does anybody know?
Because you're expecting the market to go up a little over time.
Okay, so what happens to VIX and volatility when the market goes up?
It goes down.
It goes down, right? So what happens when the market goes down? Usually VIX goes up. So what happens is this: why you'd rather be short a few deltas is because you don't get stung as much when the market goes down, because what's going to happen is this negative vega is going to sting. Oh, does it sting? This is where you get hurt, y'all. If you've ever had a bad day in the market, it's generally not because you're delta, it's not because you're theta, it's not because you're gamma, it's because you're vega. So when you've got $508 of exposure for every 1% increase in volatility. So what this means is if volatility goes up 1%, all things else being equal, I'm going to lose $507. Everybody got that, right? Make sure we got that. So yeah, exactly, Martin. It compensates for the negative vega that we have in our account. So market goes down, vega goes up, so you're getting rewarded for your negative delta. So let's say, you go down, you're getting rewarded for your negative delta, though you're getting punished for your vega. Now, if you've got positive deltas and the market goes down, you got a double whammy. You're getting hit on the head twice. You're going to lose on your deltas, right? So you've got positive 130 deltas. Market goes down, you're going to lose on your deltas, and you're going to lose on your vega. All right, so check it out. When you're short deltas and the market goes up, okay, you're getting punished here, right, for having short deltas, but you're getting rewarded for having your short vega. Well, we've had some great discussions today, and it's been fun. We hadn't traded a thing. We've just been chatting. All right, any more questions or comments? Let's go one more thing. Ed, notional Ed, as we call Ed, notional Ed. I think the best way, guys, if you want to see what your overall total, if the world went to hell, the market went to zero. All right, you want to see what your overall risk is. Isn't that it, Ed? That is notional value, right? Your overall total risk, if you just look at everything, right, would be to go to your price license, right? Make sure that you've got all your trades here. So I've got them grouped. So I've got single symbol, which is the only symbol I have in the entire portfolio. Hide your simulations and make sure you put all groups or single symbol. And then just do this. Make sure that on one of your price slices, make it this, negative 100%. So if the stock price went from, it's currently 41.30, right, at the money. If it went to zero, make this 100%. What would your overall notional risk be? Right, so gives me a good indication that if it went to zero, my notional risk is $846,000 on a $100,000 account. So I've got 8 times notional value in my account, 8.5 times of my account size. Questions?
Hey, Bobby, can you hear me?
Yeah. Hey, Gerardo, how's it going?
Good, very good here. I mean, listening to this very good chat that is happening today. Yeah, I think one of the problems most people have, and I'm glad, I mean, that a lot of people here is experience on doing this type of trades is, I mean, they get fantasizing with the blue line, profit and loss line you're showing in your analyze chart. So that is not the actual line unless, I mean, you're very close to expiration. Your actual profit and loss curve or your floating profit and loss curve is the purple one. So that's the real measure of your risk during the time all your trades are open. So everybody's going to sleep thinking, oh yeah, my profits are going to be around 5K, but when is that going to happen? That is if you don't do any other trade and you wait everything to expire. Before that happens, your profit and loss, I mean, your number at the top left on your, when you're monitoring your account is going to be the purple line. And that's what you have to care about when your price is moving.
Exactly. So what Gerardo was saying is, everybody, if you're looking at our line here, right, our lines, the purple line is what we call the T0 line. That means time now, right? Zero. In time, we're not going in the past, which would be T-1. T+1 would be tomorrow, right? T0 is today. So the purple line right here is today. So if we went down 5%, how much would we lose? Well, let's look. And you can move your little thing. So we go down 5%, we'd lose $460. Everybody see it here. But if we wait till expiration, and expiration is the whatever colored line that is, I'm bad with colors, that turquoise or blue, whatever, that is the expiration line, right? That's what we get at expiration, that one. Good, very good. All right, any other questions or comments? That's a very good comment. I think it's been great, right? We haven't done a single trade today, but we've talked a lot of stuff.
Hey, Bobby, can I add something real quick?
Sure, Stacy.
While you're on the price slices here, I'll just want to share real quick. I know everybody needs to leave. Something that happened to me during May, during the downturn that Ed was talking about. TD Ameritrade has a SPX stress test that you can do here on your price slices. I think it's 20% down move. And I did get into some trouble last month with that in one of my accounts. I had plenty of buying power, but I had reached their stress test level. And so I could they only let me do closing in my positions. And that was not fun, but I felt comfortable with where I was, and I just held on and waited to close them until they were profitable. But that is something that TD Ameritrade has.
Now, Stacy, will you double check on it? But I believe, now I may be crazy. I believe their stress is at 12%. I mean, double check that.
Maybe so. I will double check that. I'm thinking that the email that I got said 20%.
It may be for some
But
reason.
the other issue that I ran into is, I had plenty of buying power, so I was confused as to what was going on. So I contacted them. They explained it to me, but then they still didn't allow me to open any new positions until I called them back and said, hey, like, I basically only have 2 positions on now, and you're still not letting me trade. And they finally did it, but it was it made me a little anxious there for a while.
Yeah, and
I believe that 12% is for PM margin and 20% is for non-PM margin. That was my understanding, because I was in the same boat as Stacy a couple of months ago.
okay, that's great to know. Great to know, Rick. Thanks for sharing that. I mean, you look at ours, so you go, oh man, what if we had a 20% down move? Well, it says, you're going to lose 27,000. That doesn't appear much. Now, here's the problem. Everybody see this? What's your buying power effect? Well, on a $100,000 account, when your buying power goes down to 117,000, you only got $100,000 in the account. That's a problem, right? So, just go in and look at these things, monitor these things, see what your overall risk is. This has been a great discussion today, and I really appreciate all of you so very, very much. All right, so have a great day. Appreciate everybody participating today. Ed, I really appreciate your participation and talking to us about notional. And hopefully,
My pleasure, Bobby, and happy birthday to you again.
Thank you so very much. Y'all have a wonderful day. I will see y'all tomorrow.